80 to 1. That is how many ounces of silver it takes to buy 1 ounce of gold right now. 80 ounces of silver for 1 ounce of gold. This ratio has existed in human commerce for 5,000 years. And right now, it is more extreme than at almost any point in recorded history. The historical average is 15 to 1. The mining ratio is 8 to 1. The ratio during the Roman Empire was 12 to 1. The ratio set by the U.S. Coinage Act of 1792 was 15 to 1. Yet today, in 2025, the ratio sits at 80 to 1. Either gold is massively overvalued or silver is massively undervalued, or the 5,000-year relationship between these two metals has permanently broken. Here is what the smart money is betting. The ratio will revert. It always has. Every single time in history that the ratio has reached extreme levels, it has snapped back violently. In 1980, the ratio collapsed from 40 to 17 in months. In 2011, it dropped from 70 to 32 in weeks. Each time, silver dramatically outperformed gold during the reversion. If the ratio returns to its historical average of 15 to 1, silver would need to increase 433% relative to gold. If it returns to the mining ratio of 8 to 1, silver would need to increase 900% relative to gold. This is not a trade. This is the trade of the decade, and the math is about to prove it. To understand why the silver-to-gold ratio matters, you need to understand what it actually measures, because this is not an arbitrary number. It reflects fundamental economic relationships that have persisted across civilizations. The ratio simply measures how many ounces of silver are required to purchase 1 ounce of gold. If gold is $2,700 per ounce and silver is $31 per ounce, you divide gold by silver. $2,700 divided by $31 equals approximately 87. The ratio is 87 to 1. This ratio has been tracked since ancient Mesopotamia. The Egyptians valued silver relative to gold. The Greeks established ratios. The Romans codified them. Medieval Europe traded by them. The ratio is one of the oldest continuous measurements in economic history. Why does the ratio exist? Because both gold and silver are monetary metals. Both have been used as money for millennia. Both are extracted from the earth in finite quantities. Both are virtually indestructible. Both are recognized stores of value across every culture. The relationship between them reflects their relative scarcity, their relative utility, and their relative demand as monetary instruments. When the ratio is stable, it suggests the market values both metals appropriately. When the ratio is extreme, it suggests one metal is mispriced. Historically, the ratio has averaged between 15 and 20 to 1. During the classical gold standard era from 1800 to 1900, the ratio was legally fixed at approximately 15.5 to 1 in many countries. The U.S. Coinage Act of 1792 established the ratio at 15 to 1. Silver was valued at 1/15 the price of gold. The current ratio of 80 to 1 is not normal. It is not justified by fundamentals. It is the result of specific market distortions that cannot persist indefinitely. Let me explain the 3 fundamental anchors that should govern the ratio. Anchor 1. Geological scarcity. Gold and silver are both extracted from the earth. The relative abundance in the earth's crust provides a natural baseline. Silver is approximately 19 times more abundant than gold in the earth's crust. This suggests a natural ratio somewhere between 15 and 20 to 1. Anchor 2. Mining production. The amount of each metal actually produced each year reflects extraction economics. Global silver mine production is approximately 820 million ounces per year. Global gold mine production is approximately 100 million ounces per year. The mining ratio is 8.2 to 1. For every ounce of gold mined, approximately 8 ounces of silver are mined. This mining ratio suggests silver should be valued at approximately 1/8 the price of gold, not 1/80th. Anchor 3. Above-ground stocks. Unlike other commodities, gold and silver are not consumed. They accumulate. Almost every ounce ever mined still exists. The question is the relative stock of each. Estimates vary, but approximately 6 billion ounces of gold exist above ground. Approximately 2 billion ounces of silver exist in investable form, jewelry, coins, bars. Much silver has been consumed by industry and is economically unrecoverable. The above-ground investment stock ratio is approximately 3 to 1. More gold exists in investable form than silver. By this measure, silver should actually be more valuable per ounce than it is, not less. Every fundamental anchor points to a ratio far below 80. The current ratio is an anomaly, a distortion, and distortions do not last forever. Let me walk you through the mathematics of this trade, because the numbers tell a compelling story that most investors have never seen. Current prices. Gold is trading at approximately $2,700 per ounce. Silver is trading at approximately $31 per ounce. The ratio is 87 to 1. Scenario 1. Ratio returns to 50 to 1. This is a modest reversion, still above the long-term average, but normalizing from current extremes. If gold stays at $2,700 and the ratio falls to 50, silver must reach $54 per ounce. That is a 74% gain in silver with zero gain in gold. But ratios do not typically revert by silver going up while gold stays flat. They revert through silver outperforming gold, often while both are rising. Let me show you a more realistic scenario. Gold rises 30% to $3,500. The ratio compresses to 50. Silver would be priced at $70 per ounce. That is a 126% gain in silver compared to a 30% gain in gold. Silver outperforms gold by 4 to 1. Scenario 2. Ratio returns to 30 to 1. This is the approximate ratio during the 2011 peak when silver hit $50. If gold reaches $3,500 and the ratio compresses to 30, silver reaches $117 per ounce. That is a 277% gain from current levels. If gold reaches $5,000 and the ratio hits 30, silver reaches $167 per ounce, a 438% gain. While gold gained 85%, silver gained 5 times as much. Scenario 3. Ratio returns to 15 to 1. This is the historical average, the ratio that persisted for centuries of human commerce. If gold reaches $5,000 and the ratio compresses to 15, silver reaches $330 per ounce. That is a 974% gain in silver, a 10x return. If gold reaches $8,000 in a currency crisis and the ratio hits 15, silver reaches $533 per ounce, a 17x return from current prices. Scenario 4. Ratio overshoots to 8 to 1. This matches the mining ratio. In historical blow-off tops, ratios often overshoot the average. If gold reaches $5,000 and the ratio collapses to 8, silver reaches $625 per ounce, a 20x return. Now let me show you the leverage this provides. Suppose you have $27,000 to invest. You could buy 10 ounces of gold at current prices, or you could buy 870 ounces of silver. If gold rises to $5,000, your 10 ounces are worth $50,000, a solid $23,000 profit, an 85% return. If silver rises to 117, ratio of 30 to 1 with $3,500 gold, your 870 ounces are worth $101,790, a profit of $74,790, a 207% return. If silver rises to $333, ratio of 15 to 1 with $5,000 gold, your 870 ounces are worth $289,710, a profit of $262,710, a 974% return. Same initial investment, dramatically different outcomes. Silver provides leverage to the gold move plus the ratio compression. This is why sophisticated investors call it the trade of the decade. You are not just betting on precious metals rising, you are betting on a mathematical relationship normalizing. And that relationship has 5,000 years of history supporting reversion. Let me show you one more calculation, the break-even analysis. For silver to be a worse investment than gold, the ratio must expand, not contract. If gold doubles to $5,400 and silver doubles to $62, the ratio stays at 87. You are indifferent between the two. But what would make the ratio expand? Silver would need to fall relative to gold. This would require either a collapse in industrial demand, a collapse in investment demand, or both. Given that industrial demand is growing and investment demand is rising, expansion seems unlikely. The asymmetry is heavily in silver's favor. If the ratio normalizes, silver dramatically outperforms. If the ratio stays extreme, silver matches gold. If the ratio expands further, silver underperforms. 2 out of 3 scenarios favor silver. The magnitude of outperformance in the favorable scenario is massive. Historical precedent, 11 to 15. Let me show you what happens when the ratio compresses. Because this is not theoretical, it has happened repeatedly, and each time the results were spectacular. 1979-1980, the Hunt brothers era. The ratio began the decade at approximately 38-1. By January 1980, it had collapsed to 17-1. Silver rose from $6 to $50, an 8x gain. Gold rose from $200 to $850, a 4x gain. Silver outperformed gold 2-1. Those who held silver during the compression saw life-changing returns. $10,000 invested in silver became $80,000 in months. The same $10,000 in gold became $40,000. Both were excellent. Silver was extraordinary. The ratio at 17-1 was actually below the historical average. It overshot. This is common in ratio compressions. The pendulum swings past center before stabilizing. 2003-2011, the post-crisis bull market. The ratio began this period at approximately 80-1 in 2003, similar to today. Silver was $4.50 per ounce, gold was $360 per ounce. By April 2011, the ratio had compressed to 32-1. Silver rose from $450 to $49, a 989% gain. Gold rose from $360 to $1,900, a 428% gain. Silver outperformed gold by more than 2-1. $10,000 invested in silver in 2003 became $108,189 by 2011. The same $10,000 in gold became $52,778. Both were excellent. Silver was life-changing. The COVID compression. The ratio spiked to 125-1 in March 2020 during the pandemic panic. This was the most extreme reading in modern history. Then it collapsed. By August 2020, the ratio had fallen to 70-1. Silver rose from $12 to $29 in months, a 142% gain. Gold rose from $1,500 to $2,000, a 33% gain. Silver outperformed gold 4-1 in less than 6 months. The pattern is consistent. Extreme ratios revert. Silver outperforms during the reversion. The outperformance is substantial, often 2 to 4 times the gold return. Now let me show you what happens to the ratio during different market environments. During deflation and financial panic, the ratio expands. Gold is seen as the safer haven. Silver is more volatile. The ratio spiked in 2008 and 2020 during peak panic. This is when the ratio reaches extremes like 80 or 100-1. During inflation and monetary crisis, the ratio compresses. Silver's dual role as industrial and monetary metal attracts buyers. Investment demand surges. The ratio compressed in 1980 and 2011 during inflationary periods. During stable growth, the ratio tends to meander, no clear direction. It might drift between 50 and 70. Neither metal is urgently needed. We are currently exiting a period of financial panic, 2020-2023, and entering a period of inflation and monetary stress. This is exactly the environment that historically produces ratio compression. The 80-1 ratio we see today is not sustainable in an inflationary environment. It will compress. The only questions are how far and how fast. Let me explain the specific factors that will drive ratio compression in the coming years, because this is not just historical pattern recognition. There are fundamental forces at work. Factor 1. Industrial demand is exploding. Silver is not just a monetary metal. Over 60% of annual silver demand is industrial. Solar panels, electric vehicles, electronics, 5G infrastructure, medical devices. Gold has minimal industrial use. It sits in vaults. It adorns jewelry. But it does not get consumed by industry. Silver is consumed. The silver in your iPhone is not coming back. The silver in solar panels is locked for 25 years. The silver in medical devices is disposed as waste. Industrial demand permanently removes silver from circulation. Solar panel production alone will require over 200 million ounces of silver annually by 2030. Electric vehicles use 1 to 2 ounces each. Global EV production is projected at 40 million vehicles by 2030. That is 60 million more ounces of demand. Industrial demand for gold is negligible. Industrial demand for silver is explosive. This asymmetry favors silver and compresses the ratio. Factor 2. Investment demand is rising. The same forces driving gold higher are driving silver higher. De-dollarization, inflation concerns, currency debasement, central bank buying, geopolitical instability. But here's the key insight. The silver market is much smaller than the gold market. The total investable silver market is worth approximately $50 billion. The total investable gold market is worth approximately $5 trillion. Gold is 100 times larger. When investment flows increase, the smaller market moves more dramatically. A $5 billion inflow into gold is a rounding error. A $5 billion inflow into silver is a tidal wave. The price impact per dollar invested is far greater in silver. As investment demand rises, silver will rise faster than gold. The ratio will compress. Factor 3. Mining supply is constrained. Silver production has been flat for a decade. No major new silver mines are being developed. Silver is primarily a byproduct of copper, lead, and zinc mining. There are no giant silver-only projects in the pipeline. Gold production has also plateaued, but at higher levels of profitability. Gold miners are well-funded and actively developing new deposits. The supply response to higher prices will be slower and weaker in silver than in gold. Constrained supply plus rising demand equals higher prices. The ratio compresses. Factor 4. Central banks are buying gold, but silver will follow. Central bank gold purchases have hit record levels for 3 consecutive years. China, Russia, India, Poland, Turkey. They are all accumulating. Central banks do not currently buy silver, but they used to. Silver was a monetary reserve for millennia. As de-dollarization accelerates, as the BRICS alternative currency system develops, backed 40% by gold, silver's role may be reconsidered. If even a fraction of central bank buying shifts to silver, the impact on that tiny market would be enormous. The ratio would collapse. Factor 5. Retail investor awakening. The 2021 Wall Street Bets silver squeeze showed that retail investors can impact the silver market. They nearly broke the COMEX delivery system. They drained dealer inventories in 48 hours. That squeeze failed because buying pressure was not sustained, but it proved the concept. A coordinated effort to buy physical silver can stress the paper market. Social media has democratized information about monetary metals. More people understand the ratio trade than ever before. When the next wave of buying arrives, it will be larger and more sustained. Let me explain exactly how the silver to gold ratio affects you personally. Because this is not just an interesting statistic. It is an actionable investment opportunity. First, the ratio tells you which metal to buy. If you are going to own precious metals, and I believe everyone should own some, the ratio tells you where to allocate. At 80 to 1, silver offers far more upside potential than gold. The math we reviewed proves this. This does not mean gold is bad. Gold is excellent insurance, but silver is gold with leverage. It participates in all the monetary metal dynamics plus industrial demand plus ratio compression. It is the higher octane play. Second, the ratio offers a pure trade opportunity. You can trade the ratio directly by selling gold and buying silver. If you own gold already, consider converting some portion to silver while the ratio is extreme. When the ratio compresses, you reverse the trade. You sell silver and buy gold. You end up with more ounces of gold than you started with. You have increased your gold holdings without adding new capital. This is how sophisticated precious metals investors operate. They trade between metals as the ratio swings. They accumulate more total ounces over time. Third, the ratio protects against timing errors. Nobody knows exactly when precious metals will move. You might be early, You might wait years for the payoff. The ratio trade reduces this risk. Even if precious metals stay flat in dollar terms, the ratio can compress. Silver outperforms gold in relative terms. You capture value even in a sideways market. Fourth, the magnitude of opportunity is rare. Ratio extremes happen only a few times per generation. The 80-to-1 level has been reached in 2003, 2008, 2020, and now. Each time, it marked a major buying opportunity for silver. You are witnessing a generational setup. The ratio is extreme. The fundamental forces favor compression. The historical pattern is clear. Acting now positions you for potential returns that most investors never see. Fifth, the trade is accessible at any budget. You do not need to be wealthy to execute the ratio trade. Silver is affordable. An ounce costs $31 plus premium. Anyone can buy a few ounces. Anyone can participate in the potential upside. This is not like real estate, where you need 6 figures for a down payment. This is not like private equity, where accredited investor status is required. Silver is democratic. The ratio trade is available to everyone. So how do you execute the trade of the decade? How do you position yourself to benefit from ratio compression? Step 1. Understand your allocation target. The ratio trade works best as a significant allocation, not a token position. If you are going to benefit from potential 5x to 10x returns, you need meaningful exposure. Consider allocating 15% to 25% of your investable assets to precious metals. Of that allocation, weight heavily towards silver given the current ratio. A 70-30 or 80-20 split in favor of silver makes sense while the ratio remains above 70. Step 2. Buy physical silver as your foundation. Paper silver, ETFs, futures contracts, these are not the same as physical. Paper silver is a promise. Physical silver is ownership. The ratio trade works best with physical metal because you can convert between gold and silver at dealers because physical premiums track the relative scarcity and because you eliminate counterparty risk. If you have $500, buy 15 ounces of silver. Physical rounds or bars from a reputable dealer. Store at home securely. This is your foundation. If you have $2,500, buy 70 to 75 ounces of silver. At current premiums, this costs approximately $34 per ounce delivered. You own a meaningful position that will benefit significantly from ratio compression. If you have $10,000, buy 250 to 300 ounces of silver. Add a quarter ounce of gold for diversification, but weight heavily toward silver. The ratio math demands it. If you have $50,000, allocate $12,000 to $15,000 to precious metals. Buy 350 to 400 ounces of silver and 1 ounce of gold. Consider a private vault for a portion of your silver. The position is large enough to matter. If you have $100,000 or more, target 20% to 25% in precious metals. That is $20,000 to $25,000. Buy 600 to 700 ounces of silver and 2 to 3 ounces of gold. Consider allocated storage and international diversification. Step 3. Plan your ratio conversion strategy. The trade is not complete when you buy silver. You need to plan for when you will convert back to gold. Watch the ratio. When it compresses to 50, consider converting 25% of your silver to gold. When it reaches 40, convert another 25%. When it reaches 30, convert more. You are locking in profits while increasing your gold holdings. If the ratio reaches 20 or below, consider converting heavily. You will own far more ounces of gold than you could have bought originally. The trade will be complete. Step 4. Dollar cost average if you cannot buy all at once. You do not need to time the bottom perfectly. The ratio has been extreme for years. It may stay extreme for months more. Trying to pick the exact bottom is futile. Instead, buy regularly. Set up a monthly purchase. $100, $500, $1,000, whatever you can afford. Each purchase adds to your position, averaging and smooths your entry price. Step 5. Ignore short-term volatility. Silver is volatile. The paper price can swing 5% in a day. The manipulators will smash the price to shake out weak hands. This is normal. This is expected. Your focus is the ratio, not the daily price. If the ratio stays at 80, you are accumulating at favorable levels. If the ratio compresses, your existing position gains value. Either outcome is acceptable. Do not panic when silver drops. Do not sell into weakness. Hold your position. Add to it if you can. The ratio trade is measured in years, not days. Step 6. Consider leverage for sophisticated investors only. If you are experienced and can tolerate higher risk, silver mining stocks offer leverage to silver price. When silver rises 100%, quality miners might rise 300% or more. But mining stocks are not physical silver. They carry management risk, political risk, operational risk. They are appropriate only for those who understand and can monitor these risks. For most investors, physical silver is the optimal vehicle. Leverage through the ratio itself is sufficient. You do not need additional leverage. 80 to 1, that is the ratio today. The historical average is 15 to 1. The mining ratio is 8 to 1. The math shows potential returns of 5x to 10x or more when the ratio normalizes. This is not speculation. This is mathematical reversion. A relationship that has persisted for 5,000 years does not stay distorted forever. The compression is coming. The only question is timing. But timing can be improved with the right indicator. There is a specific signal that has preceded every major ratio compression in modern history. It triggered before the 1980 collapse. It triggered before the 2011 collapse. It triggered before the 2020 compression. And it just triggered again for the first time in 4 years. I reveal exactly what that signal is and what it is telling us in this video right here. Click it now. The trade of the decade is setting up. Make sure you understand when the compression is most likely to begin. I will see you there.